Hello to everyone from PwC team side. My name is Teet Tender. I'm partner responsible for advisory services in the Baltic states. I have few colleagues, as mentioned by Anna, with me today from our Central and Eastern European Business Restructuring Services Group, and they will present their background themselves in a minute. But what we would like to discuss with you today is cash flow management and liquidity, to hopefully get some ideas through to you on how to deal with cash and liquidity in the current economic situation, which continues and maybe getting worse. But Anna, maybe you can go back to previous slide for Peter and Radim to introduce themselves.
Yes, hello. This is Petr Smutný. I'm the partner based in Prague, but I have a responsibility across 29 countries in Central and Eastern Europe, and I lead the restructuring group. And we do number of operational restructuring, financial restructurings. In number of countries, we are also leading advisors in insolvency, and our key focus is on practical advice. It is to help the clients which get into a difficulty or clients which want to avoid the difficulty. So obviously, current period is not easy, and we are pleased that you joined today, and we will be pleased to share our practical experience from working with our clients.
And hello, my name is Radim Škarpa. I'm senior manager in the business recovery services. I have more than 10 years of experience with restructuring cases. And basically, I would say in each of these cases, the cash flow is the key and is the base that we use in our ongoing projects.
Thank you, guys. And can we have the next slide, please? Yes, our topics for today are structured so that first I will spend some time talking about the market and what alternative scenarios near future PwC sees going forward from here. Then Peter and Radim are going to dive a bit further in the areas of liquidity and business continuity, as well as cash management and treasury. And as outlined before, if you have any questions, please type them into the chat box, and we will have short Q&A time in the end of the presentation as well. Can I have a next slide, please? Yes, when talking about any crisis, one can divide it into different stages, and I think all of us have already experienced at least some of it. But yeah, first when it hits, companies have to do everything to react quickly. For instance, in this crisis, which is a little bit specific, of course, not being only an economic crisis. We all had to make sure that our staff will be safe. And then obviously after that, we had to attend our business continuity issues as well. How will we work further? Do we have appropriate infrastructure in place for working from our homes? Also, how much cash, for instance, do we have outstanding with clients? Or maybe we have used bank facilities earlier to finance peaks in cash demand, whether this is available still to us, and so on. Then obviously the next phase, which I feel at least here in the Baltics is either there or we're getting there, is where we sort of have kind of got used to the new situation, have established a little bit ourselves in the new times, and then obviously one would have to deal with questions like how we are going to be working further from here now that we have a negative environment, but still we know what's going on. There's a little bit of a stability. And also, what are the possible future scenarios for the business? Do we have to, establish or re-establish new supply channels, for instance, things like that? But then, as with every crisis, obviously they will end in some or another form, and in nearer or far future. And I guess, who are preparing in such times will emerge strongest from those circumstances. And we do have our client stories also from the Baltics as well, as we do have that from PwC. But I thought maybe to ask Peter actually to give us a little bit wider look, since you work across the Central and Eastern Europe every day. And what have you seen clients doing, or what have you experienced yourselves?
Yeah, I think there are like three groups of situations. So one group are businesses which are basically not very much affected. Second, and we saw this, it was, for example, in automotive industry, basically the companies Škoda, Hyundai, Kia in Slovakia, it was shut down for 6 weeks, and it had a massive impact on the suppliers. And also there are companies which could have operated, but suddenly overnight, half of the shift didn't show up because they were put in quarantine, or they were using people from Poland which couldn't cross the border, and for a number of reasons there was a operational difficulty to manage the process. So I think that phase number one is pretty, I would say, relatively easy in compared to next phases. To shut down, it's organizational, operational, but you can do it relatively easily. But now starting up an operation with a lot of uncertainty that somebody may get the virus, you need to stop. People still are afraid to come to work, which we are seeing in many countries, etc. So this sort of startup is it's a difficult period, much more difficult than it was before, and certainly a lot of operation like Škoda started, but they can operate only of half of the capacity. Some of the supply chain is not working. After a few days of operation, somebody got a virus, so they needed to stop again. Yesterday, I spoke with a general manager of one coal mine. Out of 800 people tested, they had 113 with the coronavirus, and close down the coal mine. It's not really, it is a difficult task. So now next 3-6 months is going to bring quite a lot of operational challenges, and I'm not talking about the challenges which are kind of associated with stopping production, so liquidity and demand, and I think we will be talking about it later. One last comment, because yesterday I got from some journalist a question exactly about this: are we in wave 3, shall we strategize? And I think in some businesses, yes, if you know that airline industry is going to recover after 3 years, strategic decision in respect of capacity, volume, etc. needs to be done now. Otherwise, you burn the cash which you need to do the change. So in many businesses, unfortunately, within short period of time, they need to make a strategic decision. But generally, we are now in phase 2, when things need to get back to whatever new normal, and need to start up and need to find safe way of operating.
Can we jump to the next slide, Anna? Yes, I mean, there are different forecasts, obviously, in how the economies are going to behave throughout this crisis and after it, and the differences are mostly in how deep the decline is going to be and how long it will last. Here on this slide, we have used one of the views, which is from IMF, and which I personally would consider almost optimistic, because as you see, I mean, the Baltic states here are actually pretty similar in all matters. But basically, what it says is that by the end of next year, we're going to be back where we were in the beginning of this year. But of course, I mean, nobody knows exactly. Everybody hopes for quick recovery, or quickest possible recovery. But we will see.
I don't want to be messenger of bad news, but my personal estimate is this is going to put us back 5 years at least. So it will take not 1 year, but number of years to come back to levels which we had in the Q1 of this year.
Thanks, Peter. And I think people from the Baltics remember the last crisis where we were the ones GDP-wise to actually fall most, and the numbers were in all countries double-digit negative growth. So I think we have, at least number terms, we have experienced worse than it's represented on this slide, but obviously, again, nobody knows exactly what the end result is going to be. Be that as it may, this is not our main focus today, and if it says anything, is that all companies need to be ready for changing circumstances, including those with cash, which we are talking a bit more about today. Can we go to the next slide, please? Yes, I'm sure all of you have seen those or similar graphs about the development of the crisis, and I will not go into detail here in today's context, rather than emphasizing again my point from the previous slide, that we all need to be flexible and ready for different scenarios, really. I believe all of us understand that we unfortunately are not anymore talking about the sort of V-shaped scenario, which would get us quickly back to where we were, and today we are already hoping that it's going to be this middle or U scenario, and we won't be struggling and suffering the crisis for longer term, as the L scenario is showing here on this slide. But as I said, there are different views on how it develops, but the most important aspect for companies is flexibility, and if we were preparing, as a testimony of that, or example of that, if we were preparing for a quick recovery, then we already have to do new preparations for another scenario, and Peter and Radim are going to talk about it a bit later. What does it mean to have different scenarios, and how one should go about it. Can we have next slide?
I would maybe just comment one aspect. I don't know whether L or U, but it very much also depends on the government policy. We see in many countries there is this moratorium of repayments of the bank loans. In some, like in Czech, you need to apply. In other countries, like in Romania, it's automatic, or it's in Southern Europe, it's automatic. If you don't want to be in, you need to ask. I know that in Romania they were thinking to put moratorium on all liabilities. So can you imagine if suddenly suppliers and customers stop to pay for 6 months and they continue deliveries? So it can be totally different, atmosphere. And now this moratorium, it's deferring problem. It's not solving the problem. It's just giving a breathing time 3 to 6 months. And I am sometimes skeptical about whether the government knows what they are doing, because they impose moratorium, but when the business needs fresh cash, bank cannot provide fresh cash to a customer or client who doesn't serve the claim, the previous debts. So it goes into contradiction. So I think that we are in Central and Eastern Europe experiencing a lot of this governmental help is slow, it's not practical, and I see in Germany and other countries that it's already been provided, the cash. They are already saving the businesses. We are talking about it. Yeah, in Czech it's being approved today. Maybe one of the programs may start. So I see that we may have, unfortunately, in CEE, different profile of this crisis than in some other markets. and it is driven by inability of local governments to adopt measures quickly and in a sufficient level.
Mm-hmm. Thank you, Peter. I think we are lucky somewhat in the Baltics. It seems our governments have acted quickly, and hopefully that will also show in the economic results going forward. But we will see. Let's go on the next slide, please. And maybe this is my final comments actually. I mean, PwC is measuring the temperature, so to say, with CFOs of the economies globally, and as you see from the slide, not a surprise with this crisis either. CFOs globally see that the revenue decline is obviously happening this year, but there's also some positivity about the severeness of the decline and how quickly the group sees the companies would bounce back if the crisis was to end fairly quickly. And on the other hand, as you also see on this slide, the primary measures for cost and cash saves CFOs plan for postponement or cancellation of either primarily capex investments, but also operational and workforce related costs. So can we jump on the next slide, please? And I would actually like to give over to Radim here, and maybe just one final comment from my side is that in the beginning of this crisis, I had one sort of line of positive thinking myself, which was that thank God I went through the last crisis, because that kind of put me in a position where I knew, more or less what I need to do and what I need to prepare for. And I think for all the companies as well, it is important to not to hide behind the positive hope and imagine to oneself that things are gonna end up in a more positive manner that the reality is suggesting. And therefore, when we talk about the alternative scenarios building, which we're going to talk about in a minute, my suggestion would be that always build also a very conservative scenario as one alternative, which will hopefully not come, but at least you get the comfort from the fact that you're ready, and then you will actually be ready when you need to act quickly, because again, as we will talk about, it is sometimes very important that you act quickly, particularly with cash and related areas. But by that, Radim, the floor is yours. Please continue.
Yeah, thank you, Ted. So if you here are mentioned like the 3 key stages for the managing cash flow in a crisis. I think the first one is really to understand what's the current cash position, and to understand, is there really a cash gap, when is the cash gap, and how severe is the cash gap. And definitely for this is good to have a scenario that is a base case that we are starting, but also have a more pessimistic or even a worst case, so we see how the development can worsen. Second is, once you have established the position and you know whether there is or there is not a cash gap, you need to take action and to know the steps what to do to protect your cash position. And definitely those are like internal measures, what you can do internally within your organization, how to identify savings or identify sources of cash, and also what to do externally. Is there any help? How can I apply for the government help, etc. And third, it is important to really talk about it and manage all the stakeholders and present to all of them the same information. It's maybe the information are not positive, they are negative, but it's definitely important to the stakeholders present same information and manage transparency between all the stakeholders.
I would maybe add what we have done here in Czech Republic. So when the whole situation started, we also immediately, within 3 days, we prepared short-term cash flow. So originally it was like 6 weeks, and then we expanded for 13 weeks. And it's not, we are, by PwC is stable. It's definitely not a business which is struggling, but there are many areas which can be improved. So, for example, we trained 150 of our managers for cash collection, how to talk to our clients, how to speed up the process of collecting, how to optimize the payments of VAT, etc. And I can tell you that after 4 weeks, we reduce our receivables by 20%. And the whole business, we have 1,100 employees here in Prague. Everybody understands cash is the king. And everybody is now living, collecting the cash and saving and preserving cash, not spending, because this is the key for the decision that we didn't make any people lay off. We are keeping all our people, we are preparing various programs, but we are making the business prepared for the difficult time and engaging all our people to be part of the process. So it's not the cash flow forecast, it's not a table which needs to be prepared by CFO. It is a way how to mobilize the business, the managers. It is the way how to bring transparency, and it is a way and mean for adopting right measures and implementing. So
maybe Anna, if we can go to the next slide, please. So it's exactly because for what you need is a cash flow forecast, or maybe even long-term cash flow than 13 weeks. One of the CFOs we've been talking to, he said, from the cash flow tables he was always used to do, it now turned up to be a Bible for the company. It is quite a healthy company. He said we are now changing and we are managing everything according to the cash flow. Because the cash flow, and as you see on the number one, within the operational measures, it can be like an aggregator and a tool when you see from different angles the impact of different measures, and you see whether it's enough or you need to do more, and you need to focus on another measures and really to make it more complex approach, and you will see how it all fit together on the cash balances basically. And I think that what is understandable for majority of the, or for everyone. Obviously you will know whether there is a cash gap and how to deal with it, with what parties you need to negotiate, and about what is the level you need to reach in the negotiations. It definitely need to be a flexible tool so you can change it quickly, and as we said several times, you use it in the communication. So definitely cash flow forecasts need to be for at least 13 weeks, but preferably in this case and in the situation it can be even for longer period, maybe till the end of the year or to the start of the next season in case of any seasonal businesses. So you see what you need to survive. Definitely we'll be talking now on the next slides about a model, about an example, but I would stress out that it really needs to be tailored to the conditions of each company. The principles are similar, but definitely each company is a bit different, and you need to tailor it. So if we go to the next slide, please. So in this section, we will now cover how to prepare the 13-week direct cash flow, what are the key aspects, and what are maybe some tips and hints that we have from our experience. So if we go to the next slide. So how to prepare the cash flow forecast and how to implement maybe the cash flow forecast. I think important is to understand the role of finance. Preparing the cash flow forecast is not a finance exercise. Finance department is the aggregator and is the one who is putting all the data together. But I think all the departments need to be involved. They need to be in a manufacturing company, for example. They need to be purchasing, production, HR, and basically all departments that somehow participate on the spending or generating the money. Because if you want to have it in sufficient detail and have there all the information, and you want to be able to manage it, you need to get information from the various departments. Obviously finance are in the middle. They are the ones who collect the information and manage it, the process, but they cannot do it. They cannot definitely do it alone. Where to do it, or what IT tools to use. I think we generally use always Excel spreadsheets, or in PwC use Google Sheets. We have not usually seen any working sophisticated solutions. If you want to automate it too much or link it to the ERP systems, it can take time, and definitely if in the rapid and changing environment, this can be something that might not work well. And also the implementation, the creation of this tool is a one-off exercise, but then you need to change it into a routine, because the routine and the schedules are essential, because you need to do it on a weekly, bi-weekly basis, or even if it's a really crisis situation, we sometimes do it on a daily basis. So if we go to the next, please. So how to set it up, or what's the next phases, how to set up the cash flow management process. First is to really understand what are the existing information. Maybe you have a monthly cash flow report that is reporting on payables, that is reporting on receivables. A lot of information is hidden in the special purchasing report, sales reports, and it's important to understand where the information are. Sometimes they are in the heads of the people, but definitely all the information are available in the company. It's also essential to understand the business model, because the cash flow will look different for a project company or construction company, slightly different for a retail company or a normal industrial company, and it's important what drives the expenses and revenues. Then in the setup phase, it's really agree on the templates. It's good to use simple templates, simple tables that everybody understands, everybody can fill them in. So it's tailored. It's okay to use any tables or files that were used previously. Maybe some data need to be added, and it's really important to be creative to look for the data, because from our experience, the data are in each of the company. For example, once we discussed with a purchasing manager that we need to have these payment dates and shipments for 13 weeks up front, and he said it's not possible, we'll never do it. We sat with him for 1.5 hours, and the table was filled in, because that was very experienced guy, and he has everything in his head, or he look it up. So definitely the information are there, and it's also important to focus what is the beginning, and it's very good if the beginning can be the base case. So it's a scenario how it looks if you do nothing. Yeah, if you do nothing, if you don't implement any measures, and you have all the assumptions as they are to really set it up, and then all the changes do against this scenario, so you will see what is enough, what is maybe not enough. Obviously, this is the setup phase, so these two phases, it can be done based on our experience in like 2 weeks. And then it's why you all do it. It's you don't do it to have a table, to have a report, but you do it to be able to manage the cash flow. So you need to definitely do a regular update of the cash flow. You need to compare the actuals and the forecasts to see whether maybe you need to change the approach, or something is different. Maybe some assumptions are not good, and you need to change them. And you need to set up the regular schedule. So where there is the regular cash flow meetings, when are all the information available, and when you need to fit them, etc. And obviously, it's important also, don't be afraid to iterate the process, because the process will improve as you go, and it's I think better to start with it early and iterate it than to try to make it perfect and but waste some time. So if we go to the next slide, please. As I said, basically the principles of the cash flow are the same, but there are like 3 examples of how the cash flow might and the outcomes might look like. On the left hand side, there is a large complex company, so you will basically have some aggregated sheet, and you will have then individual sheets for the individual companies, divisions, etc. But the principles will be the same. In the middle, you see if you have a let's say a typical manufacturing company, that's how the outcome may look like. So there is one cash flow, one finance manager, one person. So it's a one basically simple table that has several sources, but it is, and we will later on talk about this table. And on the right hand side, you see if it's a project company or construction company, EPC contractors, or any project driven company, then you need to do the cash flow based on the projects. You aggregate the project cash flow, and then you put it into a table with all the central function, and you have the total cash flow and the outcome. But really, it's for the project companies, is definitely a must to do the cash flow on the project basis, and that's how you do it with the responsible project managers.
And what is also important on this EPC or construction businesses, they may be showing positive cash balance, but there are a lot of deposits, a lot of cash guarantees, a lot of instruments which are tying up the cash. So they may be demonstrating they have a cash, it is true, but the cash is restricted and it cannot be used for financing the project. So a lot of little tricks needs to be, so you need to show cash available for financing, not cash overall, which is book in the company.
For example, we had a company that had on the balance sheet like 10 million euros cash, but 9.8 million euros was restricted for these various projects. So definitely, also in fact, they had no cash. So this can be sometimes tricky. So if we go to the next slide, there is so how the simple table for cash flow look like. Basically, it has three key sections. It's an income, expense, and the balances. We will talk about these three sections later, but obviously also at the balances, it's important to understand what is the balance. Is it balance with drawing the overdraft, or is it without overdraft? Do I have any cash flows that are at risk included? So I want to show the balance positive, or is it after measures or before measures? So definitely there can be several levels of these balances, and it's important to understand what I want to show and what level it is. Also, the structure in the expenses or incomes, it can be really tailored to each company, what is important, and what are the key expense items or income items. And as it is shown on the columns, it can really be, sometimes it can be done on weekly basis, and sometimes we do it really on daily basis. If you do it on the really daily cash management and you are trying to postpone maybe the payments to the very last day that's possible, so it's really sometimes important to have it on the granularity to have on the daily level. Also at the beginning, it's important to say the key assumptions for the model. So how the exchange rates maybe will be modeled, where they will be. So there is just one place where you use exchange rate, whether if there are any sales growth or any general assumptions you use, it's really good to have it on one place, and then to just use it everywhere in the model.
I think what there is, as Radim is showing ABC, but there is also section D. It's if you can pay or you can distribute the cash which you have available, but you can be carrying forward number of liabilities and payments, and it is good to have this sort of section D to show what you are deferring, because that is something what is not going to you will always need to pay, but it is important to see that you have a outstanding balance of, I don't know, 10 million euro carry forward, and you need to pay it. Because if you don't do that, your cash flow will be always positive. Yeah? Or you have to show in a certain way that you are getting into a negative cash flow, and you need to adopt certain measures how to improve it.
Yeah. So if you go to the next slide, please, Anna. So if you look at the incomes, basically incomes, simple line is really you have due receivables. So that's when you expect when you will get the money. That's basically easily done from the accounts receivable ledger. Then you have overdue invoices, and here you need to enter into discussions with your salespeople and ask them really when these invoices will be paid, and plan them when they are gonna be paid. And if you do the cash flow forecast for more than if it's for these 13 weeks, the already issued invoices will cover, let's say, up to 6 to 8 weeks time. But definitely then you need to enter also and predict the new sales. So that's why you don't have to forget on the new sales area, and the new sales that are done maybe this month enter the payment period, and then how you plan your incomes usually in the third month of the forecast. Here maybe it's usually you don't have to forget on the VAT, because there is usually in the domestic sales is VAT added. So that's obviously your income and then your expense. And also it's good that each of this stream of income is linked to the detailed sheet where you have it by customers, by products, or by anything that makes sense in your organization. And obviously it's also important to don't forget some one-off items. Yeah, there can be any sales, any returns, or other items that are really one-off. Obviously it's important also to don't forget what is the cutoff once you have it in the already booked sales, especially when you do the updates, so you take it out from the new sales, etc., so you don't have a double counting. And obviously, if you want, what are the measures typical for incomes? It can be shorten your payment terms, so provide any discounts, use factoring on receivables, and really and also as Petr mentioned, what we done in PwC is look for the overdue invoices, because sometimes it's as simple as really ask the people about the invoice. When you start asking them, they will focus on it, and you can liberate some cash that you have locked in the receivables.
I would say our internal process in PwC, what we've done over the last 6 weeks, showed we don't have clients who don't pay, but invoice can get lost, or people may change, or it various admin reasons. Was, I think, in 80% of our overdue balances was the admin reason. But we have certainly we have like steel company client, etc. You know, you need to adopt it by each individual client, each invoice, because there can be number of reasons for delaying the payment. And then this is the way for agreeing, for example, payment calendar. And if you agree the payment calendar, it is already a legal document which is recognizing the claim. So in the future, if there is a dispute, if you have a payment calendar and the agreement written in a right way, it can be as a considered as a recognition of the liability, which is very good way of protecting the receivable.
So if you go for the next slide, please, where we have the expenses. So obviously expenses, the structure of expenses very much depend on the nature of your business. So if it's a manufacturing company, it can be raw materials, any parts that you buy. So here is important to have a plan of purchases, and derived from the plan of purchases, the plan of payments. Obviously, as similar as with the incomes, initial first weeks you will have covered by the invoices you have already booked. But in the future periods, you need to have some estimates and forecasts based on the plans. Then there will be expenses that can be easily linked to the P&L as a people expenses, or any overheads and other expenses that you can plan. And then there are also taxes and other items. I would say first, the structure of the expenses can be really different from what you have in P&L, what you have everywhere. It's really how it fits and how it makes sense, and also how it is manageable. So because maybe the purchasing guys, they are negotiating with several companies, so they can manage the cash, they can manage the payments. so it is easier than done in the cash flow. In the expenses, I would definitely stress out that there should be a line linked to installment calendars, and they should be specifically tracked and monitored, and they should be done for a long period, the payment calendars, because generally we see that if the company do a payment calendar for 1 to 3 months, it solves nothing. It usually needs to be done over half a year or even longer, so you really can spread the cash gap that's there over longer period of time.
Well, we had this project on, it's a chemical business, 200 million euro revenue, and we entered into 400 payment calendars for, I think it was 6 to 18 months, but typically it was most
12,
of this
12
was
months.
over a 12 months period.
Yeah.
And we monitored it on a bi-weekly basis or at beginning weekly basis. And when there were some periods when we couldn't make the payment, but we communicated to suppliers and everything was accepted. There was no insolvency filing, and basically company after 2 years recovered, and it's now super profitable business.
Yeah, and maybe from the practical point of view, it's also good for each line of the expenses in the summary sheet to have a special sheets. Maybe it can be even special files. I know it's sometimes not recommended to link more files together, but here, if the files are shared among a group of people, it's better maybe to have them divided so they can access it and regularly update the data. So if we go to the next slide, please. So then on the next slide, we have here the outcome. So the outcome, obviously, if you have income and expense, you subtract it and you have the net cash flow. And what's important, you have the opening and the closing balance. If you have closing balance negative, you have a cash gap. If you have a cash gap, you need to somehow sort out how it will be solved. And here are it's really important to distinguish, and maybe it sounds obvious, but it's important whether you just postpone the payments or you are really able to reduce the payments. Because if you are only postponing and you have this a snowball that you have in front of you that's getting bigger, you can get into troubles. If you are, but sometimes it helps. You need to postpone at the beginning, and then you can reduce it over the time. Or you are able to really accelerate maybe your revenues. You can get new source of cash from the shareholder, investor, or even from a bank. So then it can then help the situation. But definitely the cash gap cannot be solved only by postponements and.
Well, I would say yesterday we have a client in Slovakia. So yesterday we had a bankers meeting over the Hangouts or Google Meet, and it is exactly what we presented. We presented the cash flow forecast. It showed that originally 2 months okay, but then September, August cash negative, 2 million euro. And basically we suggested the measures. So the shareholders are contributing, the banks needs to contribute, and there was some sale of idle assets, which was reducing the cash gap. But without a transparent forecast, without a proposed measures to close the cash gap, the bank wouldn't have a basis for deciding to extend the credit line or increase the credit line, etc. And while the client originally came with some projection, before we reviewed it, it was like P&L rather than cash flow. So the banks, and this was international bank, which is making an assessment, maybe not in the home country but somewhere at the headquarters, they need to see certain standard, they need to see a solution, and they need to see if they are providing the cash, that this cash will be paid back. And it is there is a process for managing the situation. So this is kind of very beginning of all of our project, when we bring A, transparency, and B, we are able through the cash flow to assess how much time do we have available to mobilize and bring resources and start the restructuring process.
Yeah, and maybe one last point to the closing cash balance. It's really important also to regularly reconcile it with the actual cash balance in the bank, so you don't end up with the different numbers in your spreadsheets and models, and actually different number in the bank. So if we go to the next slide, please. So if maybe sum it up briefly, it's important on the level of granularity. You have really 13 week is a good standard. It's a good beginning, but maybe in this crisis or in seasonal business, maybe project business, it can be also longer term cash flows. It can be done at the beginning on daily level, then you can go granularly to weekly level, and then obviously if you do a forecast for 6 months, you do it at the end on a monthly level, because it doesn't make sense to do it on any shorter period of time. Important is this regularity. So here is one proposal how it can be done, but obviously it can be really tailored to the rhythm and to the experience of each company. So you can collect data Monday, Tuesday put it together, Wednesday you have updated the projections, on Thursday you have really this cash flow meeting, and the meeting is important that there are all the decision makers. So it's really all the decisions about the payments or about postponement of payments is done on the meeting. On Friday you maybe do the payments, then you repeat the cycle. Obviously if there is a bigger crisis or much more pressure on the cash flow, these meetings can be done daily, every second day, etc. Really depends. Sometimes if you have maybe more cash and you want to spread and save some cash, you can have it bi-weekly, and you just simply tell your suppliers that the approval or your payment rhythm is every 2 weeks, and you get 1 week of cash more. Really, it's important to have it so it can be easily updated, and it needs to be done specifically based on industries. Really, different industries can have a bit different approaches to the cash flow forecasting, and also it's important to see whether you have a cash gap or whether that problem occurs in single week, or so you maybe have to spread the payments over 2-3 weeks, or there is some cumulative cash gap that it's accelerating and having more problems. And regarding the scenarios, it's really important to see what are the key drivers and what are the key items, and maybe do the scenarios on this key drivers. Because here, for example, if you have a retail, nobody now can very hardly predict what will be the revenue. So you can say, I can plan revenues 20% decline, 30% decline, 40% decline, and you will see what problems it will do, and how the cash gap can become maybe much more harder manageable.
But I would say what we do with our clients, and even in PwC, we do weekly cash flow forecast, and then we prepare an integrated business plan model, and we make these scenarios, so-called base case, when we can assume, for example, 10% decrease, but we stress critical factors, and we can see that the decline can go up to 30%. And then we have a tool for modeling, if there is a decline like at 20%, what sort of measures we will adopt to be able to manage the situation and maintaining the flexibility. So there is always a range. So we work with base assumption, but we have possibilities for seeing the impact when the market will go down or market will go up. Yeah. So we have prepared a kind of 15 months business plan for the future period till end of June 2021, And we are now modeling various impacts and measures which we will be adopting.
Yeah. So if you can go to the next slide, and it's basically let's now look at the measures. Yeah. So let's go directly to the next slide. So obviously, it's where is the cash, and where a lot of companies have, I think, in nowadays a lot of cash is the working capital. It's really to look at all the elements of working capital, so the payables, receivables, and inventory, and really try to find there the ways how to get money and how to improve the cash flow. So I think working capital is really the first item to look at. Second is look at what can be the new funding, whether there is any equity can be raised, or there is any government aid in current situation, or really you can do new investments or additional funding maybe from the bank. So if you look at the income part, it's really important to become on the cash collection. Sometimes I know that the salespeople, they will always tell, I don't want to worsen my relationship with the client, so it's maybe worth to implement a new position. You can call it cash collector or whatever, so they can raise the cash and they will help with the collection. Really, you can look about sell any non-core assets, really try to find if you have any financial savings, etc. On the expense side, it's important to really focus and cancel any unnecessary orders, and really to focus before on each spending before the spending is ordered or committed. So once you do it, you really can and you focus only on the things you need for the business. Obviously, big part of many businesses is people and the labor costs. It really much depend on the local regulation and maybe on the ability also to agree with the employees. And I think the cash flow tool maybe can be used also for the employees to understand the situation, understand the problem, and understand if there is nothing done, there will be no future. But if there is something done, and everybody will sacrifice something, that there can be solutions found and implemented. And then there are obviously cost cutting, cut investments, or postpone them. Obviously, if these things will be done, it can worsen and create some vicious cycle in the economy. But if you don't have money, obviously the companies will not invest. So if we go to the next slide, it's also important to use the information from the cash flow to communication with creditors, whether you are not breaching any covenants, etc. And obviously, if the problem is greater, it needs to be the focus on the cost cutting and cost reduction needs to be more, let's say, sophisticated, or with restructuring officers or even project management roles. So if we go, Anna, to the next slide, please. Here you can see the cash flow and the typical examples, how it can be presented to the management and for the decision making. You see that there are measures that really improve it. That's in the B part. So it's the long-term cash gap, and you really need to do cost cutting or get sales of any new product. So you put the line above zero, because if you do just the transfer of payment, that's how you can solve any short-term gap. But as you can see in the line 1, transfer of payments, once you stop paying something, you will have to pay it in the future. So this is to show you an example how it can look, and so it's visualized, and the cash flow outcomes and the implementation of the measures. So if you go to the last section, please. So here is communication. Obviously, it's really, you do all these exercises to manage the cash flow, but then you need to communicate it to all the stakeholders, and stakeholders meaning all the internal ones and also the external ones. So if we move one slide more, it's for the internal purposes, it's really important not to hide it that you are doing this exercise. Really announce the outcome so everybody knows where it is, that the situation is under control. It may be critical, but still it's manageable. It's also important to present similar information to and consistent information to creditors, maybe to shareholders, to landlords. It can be now in these days, so they see that you really cannot pay them even if you even if they want. And I would say the third point is the most important. Like, really, don't be afraid to say the unpleasant truth. It is better accepted, and really better accepted, than a lie. Even if the employees, if they will know and they will say, we will pay the wages once we have the money, but we don't know where it is, it's for them much better and much more acceptable information than to tell them it will be in 2 days, and in 2 days you tell them no, it will be in 3 days, etc. But once they lose the trust, it's very, very hard to get it back. So I think that's maybe all from our side. We are also reaching the 2:30 here time in Prague, so maybe we can now move to the questions, whether we have any.
There are a couple, Radim, actually, in the chat box, and I think first one you just answered pretty much. It says that what are the suggestions in communication with banks these days, how to prove business viability to them to receive financing. I believe you just commented on it, but maybe you want to add something in addition.
Well, this is exactly the scope of our project, which we are doing in Slovakia. The client got into difficulty, the bank reduced the working capital line, and now to get it back, they need to come up A, with transparency, B, the plan, how to improve and change the business, and C, what sort of measures are available, like this governmental funding, equity from shareholders, etc. And the bank will not even talk to them if they do not come up with a robust forecast and something what is the basis for the bank to be to decide. So, and I think our experience is that there has to be good transparency, no lies, and consistency. You cannot come to the bank with one message and 2 weeks later with another message. And we see that the typical situation where there is an owner in the management function, he brings a lot of emotions and a lot of sort of historical matters. Yesterday we experienced, because this owner was pushing the bank, last year on the financing, he was really squeezing them on interest. And now he is getting into difficulty, and immediately the banks remembers and is not demonstrating that level of flexibility. So there has to be good relationship, and it's really, I would say, word number one is transparency.
Thanks, Peter. And maybe just very quickly answering the second question as well, which is about cash flow tool. In case of a retail company, would you suggest to still have the income part based on invoices or sales from profit and loss, or based on percentage of revenue, in brackets, direct cash versus invoiced?
Yeah, in a retail company, it's different. It can be even some model. Well, the data will be now different, but doesn't have to be based on invoices, but basically on seasonality of the sales or any experience from the past.
But it's based on cash collection. So you will not assume, it depends on the mix, but it's not only invoices. If you don't issue invoices, if you sell through credit cards or cash, you
through simple like sales that people go to the shop. So you have some models in the past, and based on this, you will have to model it based on revenues, because most of the incomes most of these revenues will immediately become your incomes. It can be different with the credit cards or with some payments. Yeah. That can be some deferrals, but generally that would be.
We've done also a project with internet shop on closing. So certainly you need to assume that you have to make a lot of refunds. So that is absorbing your cache as well, and you can play with this source as well. So it very much depends on business industry, how you model it. It's not rigid, but you have to reflect the reality where you operate.
Thanks, Peter and Radim. And I think this is, concluding our webinar. We are a little bit over time. Thank you very much to the people who joined us. I hope you got some useful tips and tricks how to manage this challenging environment here. If you have any other questions, want to discuss further, please reach out to us. Thank you to Peter and Radim for joining us, for sharing your experience from all over Central and Eastern Europe. And Anna, are there any closing remarks in terms of administrative areas like the recordings or something like that?
I would maybe one last comment. What we have done similar webinar for our clients here in Prague and other countries, and we offer them a kind of free of charge 1-2 hours consultation. If they prepare their own model, we are happy to have a discussion with them just to review and maybe answer on some tricks and tips what can work, etc. So if this is relevant and if you would need some help, you can approach us, and we are happy to, with some limitations, to give you some comments and hints.
Thanks, Peter. And again, you can reach out to us through the Baltic offices or directly to Peter and Radim, obviously. So I believe that concludes our presentation and meeting. Again, thank you very much to everybody for participating, and hope we will see each other soon, or at least talk to each other soon. Thanks very much, and have a good day.
Thank you. Bye-bye.